Good afternoon, Mr. Fritz Seidi. Happy New Year.
Happy New Year, Miss Wood. You look so good today.
Thank you.
All
So I'm
right.
good in you.
Very good.
Now it's tax time, and I
Mm-hmm.
know that everybody's looking for good information from professionals that have the knowledge to answer their questions. Let me have the opportunity to ask you a few questions regarding the updates for the 2020 tax season. My first question is, what are the changes that will affect taxpayers the most this year?
Well, this is a very good question, Miss Ruth. Well, since 2017, December 22nd of 2017, President Donald Trump signed into law what with Tax Cuts and Job Acts of 2017, and that took effect in 2018. Since then, we have a lot of changes in the tax laws. And of course, we call them updates, as you just mentioned. And we have many updates that took place in 2018, and they keep on taking place every year because those updates, most of them, will expire in 2025. So it's a good, like, 2017 to 20, like 8 years. You understand what I'm saying?
Mhm.
So today, since we are informing our audience, and of course, we would be pleased to talk a little bit about education savings bond program, the qualification. We'll be talking about social security, especially tax earnings limit, and we'll be talking, of course, about this very popular subject and the subject that frightens the IRS because there are so many corruptions out there. People are taking advantage of the system. We're talking about earned income credit. And of course, at the end, you may have a question, to recap everything. But that is what we'll be talking about among so many other updates when it comes to foreign investment, when it comes to a bunch of activities. For now, we're talking about individuals. When we go to the business, to corporations, everything, there are many changes.
Hmm.
Yeah.
Before we go to the topic of earned income credits, let's take a brief look at the Education Savings Bond Program. What does the Education Savings Bond Program do for the taxpayers, and what are considered qualified education expenses?
Well, this is a great question. Now you're really getting scientific because this is a double question. Of course, I'm going to answer both parts for you. First of all, the first question was, what do education savings bond do for taxpayer? And I'm going to answer this part first, and then we will be talking about what qualified, etc., the qualification, the qualified expenses. First of all, although the interest rate or on U.S. savings bond is normally taxable, okay, as ordinary income, a taxpayer excludes some or all of the interest on certain cashed-in savings bonds if he or she pays qualified education expenses and meet federal income tax filing status and income requirements. Under the federal education savings bond program, a taxpayer may exclude some or all of the interest income received on unqualified U.S. savings bonds if the taxpayer, first of all, paid qualified education expenses for the taxpayer, a spouse, or a dependent claimed as an exemption. Secondly, the taxpayer has a modified adjusted gross income not exceeding a specific maximum amount that are adjusted for inflation each year. And third, and lastly, the taxpayer has a federal income tax filing status than married filing separately. You hear that?
Mhm.
Only married filing separately don't qualify. Those couples, they don't qualify under this program. So the U.S. savings bond that qualify for the education savings program are Series EE bond and Series I bond. That Series EE bonds that were issued when before 1989 or after, not before, but after 1989, and Series I bonds. The bonds must be issued either in the taxpayer's name as sole owner or in the name of the taxpayer and spouse as co-owners. Furthermore, in order for the bond to qualify for owning, taxpayer must have been at least 24 years of age before the bonds is issued. Okay? Before the bonds date of issue. So the next part of the question is this: qualified education expenses. Education expenses that qualify for the education savings bond program are education expenses incurred at an eligible educational institution by the taxpayer, for the taxpayer's spouse, or a dependent claimed as an exemption by the taxpayer. Such expenses include what? Include tuition and fees. Everybody knows what tuition fees are. Okay, there's no need for us to develop, too many details here. Contributions to a qualified tuition program, and also includes contributions to a Coverdell education savings account, um, commonly named ESA. All right. So room and board expenses. Remember this: room and board expenses. If you have your child attending college or university, you must make sure that any expenses you incurred in terms of room where the child must sleep and board, they're not included in qualified education. Okay? Expenses for purposes of the education savings bond program. One thing you didn't ask me that I'm going to add is the eligible educational institutions. Okay? Ineligible educational institutions for purposes of the education savings bond program is broadly defined as one eligible to participate in a student and program student aid program administered by what? By the U.S. Department of Education, and those include college, university, vocational school, and other post-secondary educational institutions. So those post-secondary education institutions, they must, comply with certain requirements in order for them to qualify.
Mm, that's good. And my next question is, what are the Social Security taxes made of?
Well, very good question, because I know that from the audience, we have many people age of 65 or younger people, but that have been sick to a point where they qualify for to receive Social Security. So we're talking to these people here. So Social Security taxes are comprised of two components. As an accountant, I prepare payroll. I'm used to this, and I know exactly what it entails. So we have two parts. The first part is named with a short name OASDI. OASDI, meaning old age survivors and disability income. Old age survivors and disability income. And HI stands for health insurance taxes. Okay, those
Mm-hmm.
two taxes. So OASDI is a tax imposed on a tax on a worker's wages up to the applicable Social Security taxable earnings limit. So we're talking about a limit here. For Social Security, there's a limit. In 2019, for the tax period 2019, is $132,900 for Social Security. And generally, it increases annually, to adjust for inflation. Okay, to adjust for inflation. But the employee tax rate for the OASDI part of the Social Security is 6.2%. 6.2%. It doesn't really vary, but under President Barack Obama, they brought it down to 4.2%. It's like they gave people a break of 2%, but not too good because when you retire is when you need the money more, the most, I would say, the most. Because when you're young, if you can save for later, that's a best thing. So that is taken back to 6.2%. Okay. Now, when it comes to HI, health insurance, you see, the second component of Social Security, it is a tax of 1.45% imposed on all taxpayers' wages. No earnings limit applies when it comes to medical or Medicare, I would say, because this is the money that funds the Medicare Part A. When you retire, you turn 65, or you are, seriously ill, and then you must receive Social Security. So it's people at that age, they do receive Social Security after a period of 24 months. You see, after a period of 24 months, there are many things they cannot do on their own, or they deserve, to be covered under Social Security, under Medicare. Okay? So they receive Medicare. Well,
Hmm. That's very interesting.
yes, it
And,
is interesting.
and can you tell us a little bit about the maximum capital and the divided tax rate for 2019?
Well, this is a good question. Wow, Miss Ruth, I don't know where you got those questions from me, but this is good question, and people are getting informed. Correct?
Mm-hmm.
Okay, that's good to share what you know, what you have with other people. And of course, I know that my audience is going to be so happy with this information. And when they need more information, they're going to be calling us. Correct? Good. All right. Well, so maximum capital gain and dividend tax rates increased for high income taxpayers. Increased, not diminished. Okay? Not decreased, increased. Okay? Contrary to what many people are saying, so the tax cuts benefit the big earners, and people with low income or low income earners, they're not benefiting from it. As a tax practitioner, I don't see it myself because I am with the law in hands and I'm paying attention. You understand what I'm saying? Okay, so high income taxpayers are subject to higher capital gain and qualified dividend tax rates. So for tax year 2019, the long term capital and qualified dividend tax rate is as follows. Before I go to the detail, let me explain long term capital gain. Long term capital gain is gain earned, okay, on investment that are older than just 1 year. Because if you had a bonds or you had a stock or anything else that provide a capital gain for more than 1 year, we call that long-term capital gain. But anything 12 months or less is called short-term capital gain, short-term investment. You got that, Miss Wood?
Mm-hmm.
Okay. So now we have three categories when it comes to the tax, capital gain and dividend tax rate. Okay. The first category is 0%. The second category is 15%. And the last and third category is 20%. Okay. Now we're gonna go in details about these, you know, tax rates. The 0% rate applies to single filers with income up to $39,375. The same rate applies to head of household filers with income up to $52,750. And the same 0% rate applies to joint filers with income up to $78,750. Okay, and the same rate apply to trust and estate with income up to what? To $2,650. Trust. I'm not going to take a long time talking about trust, but that's why many people understand what it does for them when they create a trust. Because when you create a trust, the trust pays less taxes on earnings. Okay? 0%. The 15% rate applies to single filers with income between $39,375 to 400 or to $244,425. Okay, you got that? Filers, 15% rate apply to single filers with income between 39,375 and $244,425. The same rate, 15% applied to head of household filers with income between 52,750 and $461,700. Great amount. And the 15% applies to joint filers with income between $78,000, $78,750 to $488,850. So you can see from everywhere, we're talking about credits, we're talking about investment, they don't consider married couple that file taxes separately. So they talk about joint filers, they talk about head of household, they talk about single people, correct? So in the trust and estate with income between $2,650 and $12,950. Okay? And the last category, which is a 20% rate, that applies to individual filers with an income exceeding $244,425, applies to head of filers with income exceeding $461,700. Okay, and the 20% rate applies to joint filers with income exceeding $488,850, and trust and estate with income exceeding $12,950. So when people create a trust account, that benefits them from avoiding paying too much tax. Okay, so this is very important. Now, ready for me for another question?
Yes, and my question is, what is the earned income credit?
Wow, Miss Wood, now you're getting into the most popular topic here because we're talking for family earning certain level of income, low income, blah blah blah. You see, the well, I don't know if people will hear me out there. I have no idea, but we continue because it's very important. Okay, so well, earned income credit is what? The earned income credit (EIC) is a tax credit for certain low-income working taxpayers who meet income filing status and other requirements. Eligibility to claim the credit requires, among other things, that the taxpayer have an earned income. The taxpayer also have an adjusted gross income below a specific level. The applicable AGI, adjusted gross income level, generally changes annually. Unlike the Savers Credit, EIC, earned income credit, is a refundable credit, and accordingly, it is available to eligible individuals regardless of whether or not they have a federal income tax liability. What is income tax liability? It's one word: debt. If they have a debt, whether they have a debt or not, they deserve to get the credit when they qualify. Understood? Correct?
Mm.
In order to receive EIC, earned income credit, the taxpayer has a qualifying child. Okay. I'm sorry, I'm jumping here. In order to receive earned income credit, the taxpayer must meet certain rules. And the EIC rules fall into three categories. First category, rules that apply to everyone. Second, rules that apply if the taxpayer has a qualifying child. And third, rules that apply if the taxpayer does not have a qualifying child. So EIC rules applicable to everyone is determined, or when you are when you are determining whether a taxpayer qualifies for EIC begins with the 7 rules that apply to everyone. If the taxpayer meets all of the 7 rules that apply to everyone, the taxpayer must then meet the additional rules that apply: A, if the taxpayer has a qualifying child; B, if the taxpayer doesn't have a qualifying child. The rules for everyone is this, as follows: adjusted gross income, AGI, correct? Social security number, tax filing status, citizenship and or residence, correct? Foreign earned income, investment income, and earned income. From this qualification, I'm going to put emphasis on 2 of them, even 3. If you don't have a valid social security number, you cannot claim EIC. Residency or citizenship: you may be a citizen of the United States. You may be somebody from other countries, but you have a green card here. This is very important because this is immigration status. Okay? And investment income is very important also, because if you have investment income below, I think the limit this year is about 3,650. I'm not sure because I don't have the number in front of me, but it is in that area. So if you have an income past that, if you don't have a social security, you don't have a citizenship or residency, forget it. You may have 50 children here. You're not going to be able to claim any earned income credit. And that is, the law. So to be in compliance, whenever you are filing your tax returns, you must have your social security card with you. Everybody you're going to have in the tax return, you must bring their social security cards so that the taxpayer can take a picture of them. This is to be in compliance with the rules established by Uncle Sam.
Hmm.
Uh-huh. Any
Very
more
nice.
questions for me?
And also, finally, can you give an audience a thumbnail summary of the 2019 changes?
This is very good. So, Miss Wood, you are very ordered. You go orderly. And of course, you understand, after all this information, people would like to have a recap. So recapitulation, a recap means that we're not going to take everything in detail, but a thumbnail, as you said it. Okay? All right. So the standard mileage rates. This is the one thing we didn't cover this year. We didn't cover in this session, but we can give you. This is part of the summary because everybody knows that uh, there is an expense that it can claim for each of these, for charity, for medical, travel,
Mhm.
and also for business travel. Okay, so
Mhm.
they can claim certain amount. So this year for the charity, the rates remain the same, 14 cents, 14 cents on the dollar. That means 14%, 14 cents on the dollar. For medical, it has changed from 18 cents to 20 cents per mile. And for business, it is changed also from 54.5 cents to 58 cents this year. So people who can claim mileage, they're going to claim bigger amount of money because that's what the tax cut means. Okay? Now, when we come to standard deduction, this is one area that is of great interest. Standard deduction for married filing jointly and surviving spouses. And last year it was 24,000. This year it is $24,400. So it's increasing every year, annually. Married filing separate and single, 12,200. So single and married filing separate are treated almost the same way when it comes to standard deduction. It is half of the standard deduction for married couple filing jointly. That's correct. And head of household this year it is 18,350. Last year it was just 18,000. And additional standard deduction for blind or elderly, married, 1,300, and head of household and single, additional is 1,650. Exemptions suspended under Tax Cuts and Jobs Act of 2017, beginning in 2018. So we don't have any more personal exemptions like that took into account amount people would spend for their personal hygiene, personal everything. So that is cut off. No more personal exemptions. Okay, and that started since 2018. Now people are getting used to it. Correct. And alternative minimum tax. Many people are interested in here. Alternative minimum tax, single and head of household, 71,700 dollars exemption, 25% phase out, beginning at $510,000 taxable income. So people with taxable income in the amount of $510,300, correct? Single or head of household. So they have an exemption of $71,700. This exemption reduces their tax liabilities. And also they can phase out at 25%. Correct?
Mhm.
Married filing joint or qualified widower, okay, 1100 $111,700 exemption, correct? And 25% phase out beginning at $1,020,000, $20,000, 20,600. 1,020,600 taxable income. Taxable income. All right?
Mhm.
And married filing separately, 55,850 exemption for married filing separate, and 25% phase out beginning at 510,300 taxable income. And estate and trust, always lowest, correct? 25,000 exemption, 25% phase out beginning at 25,000 taxable income. Still good to have a trust account, correct?
Mhm.
Education savings bond interest exclusion. We talk about this, correct?
Mhm.
Single head of household and qualifying widower with modified adjusted gross income of $81,100 to 96,100. These are limits, correct? And married filing jointly, it's between 121,600 to, oh, yes, to 151,600. These are the limits for education savings bond interest exclusion. Okay? And the limitation on itemized deduction, phase out of itemized deduction suspended under tax cuts, you see, and Jobs Act of 2017, beginning in 2018. Limitation on itemized deduction, phase out of itemized deductions suspended under tax cuts and Job Act of 2017, beginning in 2018. It's not new, correct?
Mm.
And we also have other things here, qualified long-term care, insurance premiums and benefits, blah, blah, blah. We'll talk about these in another session. But today, this is almost about it. Let me finish with Social Security and medical expense. Social Security taxable earnings limit. The limit, I said it earlier, and this is a recap. The limit is what? $132,900. And the medical expense education threshold. The threshold means uh, 10% of the adjusted gross income, and anything exceeding 10% of the adjusted gross income, it can be deducted, is deductible. For example, suppose that I work for $1,000. I'm just giving you an example, correct? And then 10% of 100,000 is what? 10,000. 10% is $10,000. And then I have medical expense for $18,000. How much am I going to be able to deduct? It's anything in excess of $10,000 of my AGI, modified AGI, adjusted gross income. So now the 10% is 10,000 because of my expenses amount to 18,000. So I will be able to deduct $8,000. That's what it means when it said 10% or medical expenses deduction threshold. That's what the threshold is. So, Miss Ruth, I think we did very good today.
And thank you, Mr. Fritz. It was a pleasure having you answer these questions.
To me, also, it was a pleasure, Miss Ruth, and you had very good questions. And I'm hoping that the audience will respond to this video by calling us at 561-501-9391, repeating the number 561-501-9391. They can also visit us on www.taxmeltdown.com. www.taxmeltdown.com. And there they will find everything they need, and they can actually register. See if they have more questions, if they have any interest into our income tax service here, we will be more than happy, to serve them. All right. So, having said that, Miss Ruth, I think this concludes our session for today. It was a pleasure again for having me. And of course, you who are watching, I really appreciate that you watched. And we want to thank you. And we are waiting for your call, for your referrals, everything. Because the greatest gift you can give a professional like us is, refer your friends, your family members to us. And that is the greatest reward you can give us. Thank you very much. Once again, it was a great pleasure to to be of service to you today. Bye bye.